Alright, so as decided, first we'll be doing all the formulas of time value of money as well as valuation of security, which we have come across up till now. So let us first start a revision with the time value of money, all the formulas. Is it alright? Time value of money. First, a general formula of future value. A is equal to P into 1 plus I raised to N. If K is involved, A is equal to P into 1 plus I upon K raised to N multiplied by K. What is K? Number of times interest is calculated in 1 year. If you need to find out the present value, it is A into 1 divided by 1 plus I raised to N. Similarly, if K is involved, you can just formulate the formula. If you want to find out the real rate of interest, what you need to do? 1 plus I upon K, where I is nominal rate of interest, raised to K minus 1. You will be directly getting answer of real rate of interest. But if the question is of finding out the present value as on today of infinite cash flow without growth, it is infinite cash flow without growth, then how to find out the answer? If you want to find out value at the end of 0 year, you should start with cash flow of first year divided by rate of interest. Is it alright? If you want to find out the present value of infinite cash flow with growth, how I can find out? Cash flow of first year divided by rate of interest minus G. Is it all? Also, we have learned if you are not having growth rate, you can find out growth rate by B multiplied by R, where B is retention ratio and R is rate of return. It can be return on investment. It can be return on equity. Is it alright? So, these are all the formulas that we did in the concept of time value of money. Is it alright? And we have done that 8 to 10 types of questions which you need to solve, and you have understood how much time value of money or finding out present value is important even in the chapter of security valuation and analysis. Is it alright? These were all formulas of time value of money. We are going to formulas of security valuation and analysis. Alright, first I am starting with the concept. How to value the security. Understand, anything in finance can be valued by present value of future cash flows. If you find out a present value of future cash flows, you will be always getting answer of valuation in finance. We have learned it in bond also. If I discount it at my rate of return, it is my valuation for the security. If I use YTM, it is always a market price of the security. Let us understand some of the formulas which we came across in security valuation and analysis. First, I am taking from that based upon ratios question. It is interest and fixed dividend coverage ratio. Interest and fixed dividend coverage ratio. See, whenever it is coverage ratio, the name of the coverage ratio will come in denominator. Whatever it is, interest plus, which is fixed dividend is a preference dividend. From where this is paid from? Profit after tax? No, because in profit after tax, interest is already reduced. You need to take a profit before that interest, but after tax. So just I am adding the interest over here. So this will be interest and fixed dividend coverage ratio. Is it alright? Interest coverage ratio. What will be in denominator? Whenever it is coverage ratio, the name of the ratio will come in denominator. Interest. From where interest is paid from? EBIT. So it will be EBIT divided by interest. Higher the coverage ratio, better is for the company. Fixed asset turnover ratio. Again, it is the turnover ratio. It will come in denominator, fixed asset. What will come in numerator is turnover. These are the formulas which were used in based upon ratios question. But please understand which formulas you will have to learn is go to intermediate, learn all the formulas for ratio analysis. All the formulas, profitability, turnover ratios, profitability ratios, coverage ratios, other dividend ratios, each and every formula of that ratio analysis you should learn, because in final the concept can come from any of the formula and your base should be absolutely clear. This I have written just because they were covered in our some of the questions. Return on equity is earnings available to equity shareholders divided by equity. Equity includes equity share capital plus reserves multiplied by 100. Other formulas. We started with that preference share conversion. Is it alright? Preference shares were convertible into equity shares, whether it should be converted or not, and they were second type of ratios. Conversion value of preference shares is nothing but a number of equity shares multiplied by market price of equity shares. This is the value which you get if you convert your preference shares into equity shares. Conversion premium is market price of preference shares minus conversion value divided by conversion value multiplied by 100. Is it alright? I am writing the formula we have understood logically before also. Is it alright? Then we went to conversion parity price. What was it? Market price of preference shares divided by number of shares. What is this? The market price of the share at which you are indifferent whether you convert the preference shares into equity shares or not. Above it you should convert it into equity shares. Below it you should not convert it into equity shares. Percentage of downside risk. It is market price of preference shares minus straight value of preference shares. If the preference shares are not traded into the market, what is the minimum price? We have understood this concept also. Divided by straight value of preference shares multiplied by 100. These were the four formulas relevant for that conversion questions. Then we went to EVA. In EVA, we have also done that formula of financial leverage, degree of financial leverage. Is it all right? What was it? EBIT upon EBT. Again, the leverage chapter is full-fledged in your intermediate. You should be having a brief idea of it. Is it all right? This is degree of financial leverage. But what is EVA? It is no part minus your capital employed into weighted average cost of capital. Capital employed is equity plus debt. Weighted average cost of capital is KO. No part. What is no part? No part is EBIT into 1 minus T. You will be getting answer of economical value added. Again, we have done this concept logically. Whenever you revise, you should revise it logically, but ultimately you should be knowing the formulas. Then we went to bonds. Let's do it. In bonds, what was the first concept we learned? YTM. If you purchase the bond today at the market price prevalent in the market, and if you hold this bond up till maturity, what is the rate of return you are earning? It is nothing but IRR of bond. Actual rate of return of bond. If you want to find out IRR, you need to understand your basic formula, which is base rate for that interpolation technique plus positive NPV divided by difference in NPV multiplied by difference in rate. But there is another formula by which you can find out YTM approximate, which is interest plus redemption value minus market price upon N upon redemption value plus market price upon 2 multiplied by 100. You also get YTM, but it is an approximate value. This is YTM, yield to maturity. Then we went on understanding duration of the bond, Maclaurin's duration of the bond. It is average number of years in which the investment is recovered. How to find it out? IW. I should be taken as years. Weight should be taken as a present value of cash flow at the rate of YTM. You are having I, you are having W. Find out weighted average by sigma IW divided by sigma W. You will be getting answer of duration in years. It is also measurement of risk. Is it higher the duration, higher is the risk. Then we went to learn modified duration. What was modified duration? It is Maclaurin's duration divided by 1 plus YTM. If this Maclaurin's duration is 6, always revise this. What does it mean? If market rate of interest changes by 1%, then price of bond will change by 6%. This is meaning of modified duration. Now understand, this both are having inverse relationship. What does it mean? If market rate increases by 1%, the price of the bond will decrease by 6%. If the market rate of interest decreases by 1%, price of the bond will increase by 6%. Means they will be having negative correlation, or they will be going in different direction. This is meaning of modified duration that we have learned. Also, in last question, if you remember, we have done a concept of realized yield. What we did is this. Is it alright? To find out realized yield, first we found out total cash flows, including redemption value, including all other interests, divided by investment. Is it alright? This was comparable with 1. Is it alright? So this figure is 1 plus I raised to N. And we solved and found out I, which was nothing but realized yield. What is realized yield is nothing but if the coupon is not reinvested, what rate of return the investor is getting. It is asked only one time in examination, but still if it is asked again, you can easily solve it just by using this formula. This was one, and the last portion which we did was a right valuation. In right valuation, we first found out X right price of share. How we found out? Old value, number of shares multiplied by existing market price of share, plus new borrowing from right. This is new value, addition in value of the company, divided by n, that is old number of shares, plus n, that is right shares. Right. So I should not write down, it seems it is multiplication, n is right shares, n1. So that is total number of shares after the right is issued. I will be getting X right price of the share. If someone tells me to find out value of right, how I will find out X right price of the share minus subscription price of right. What is the value of the share after issue of right minus the price at which the right shares was available to the shareholders? Sometimes it is also done in this manner. Value of the right is found out per share. Value of right per share holding. So for every 2 shares, if one right was available, then this value of right would be divided by 2. For every 4 shares, if one right was available, this would be divided by 4. If for every 10 shares, one right shares was available, this was divided by 10. So total value is divided by number of shares for which you get one right shares, so that you get value per share, value of right per share you are holding, etc. And this was the last portion of security analysis and valuation, valuation of right shares. So these are all the formulas related to time value of money, security analysis and valuation. As I told you, even if I am drawing it, just taking a snap is not relevant. You should always prepare your own formula book whereby all the formulas are readily available. If you are revising ratio analysis from intermediate, write down all the formulas of ratio analysis even in your formula book. So this is end of the chapter of time value of money, security analysis and valuation.